Hi, I'm Sameer Jain. I recently attended an excellent panel at a fairly large private equity real estate firm where there was a great session on assessment of real estate markets and what does it suggest for the broader economy. So some takeaways that I thought I'll share with you. It seems that core real estate remains moderately attractive in 2018. It seems to be fairly valued, and past returns have been driven by cap rate compression. Fundamentals had rebounded with low vacancy rates and steady higher absorption, and low interest rates had been supportive, but that seems to have changed. So most sectors are expanding according to them. So one sees a general improvement across industrials, office, lodging, storage. Probably the greatest improvement is in the apartment sector, which is driven by, of course, job growth and young people avoiding home ownership. It seems that there are few oversupply risks, except maybe in senior housing and some types of malls. Apartment supply remains high, but is being matched with high absorption, and I guess it's also driven by job growth. Healthcare remains one of the fastest growing sectors, and with many opportunities in medical offices, hospitals, skilled nursing, assisted living. Office markets vary widely, with Austin, New York, Boston, San Francisco doing well. And of course, oil industry dependent cities such as Houston have been feeling the brunt, though now with oil rebounding, one would expect a change. Industrial supply has increased, and in anticipation of a still improving economy, hotels remain, supply remains constrained except in a few gateway cities. Some of the better opportunities continue to reside in select service hotels that are affiliated with major brands located near high demand generators, and a higher dollar may discourage foreign tourists, but more than offset with domestic economic growth as unemployment declines, spending and travel improves. What they said is retail in general is overbuilt, but with little supply now coming on board, high-end malls, grocery anchored malls seem to be good places to invest in, and conditions remain in place for a robust economic performance in 2018. And of course, going forward, things will depend on energy prices, and if whether trade wars spike inflation, budgetary and fiscal deficits increase, and of course whether personal and corporate balance sheets continue to strengthen. Core real estate seems to be fine, but no cigar. Corporate profitability is at a high, and which has been supported of business travel. And it seems it's also a good time for higher quality hotels that are frequented by business travelers. So as the economy continues to improve and wages and employment rise, not sure if employment can rise anymore. One would expect a pickup in personal travel too. Most markets have low supply except for a few places such as Miami, Houston, New York. Demand has been growing. The stronger dollar, they said, is likely to hurt foreign tourists visiting the US, but the effect is likely to be modest as travel bookings are often made well in advance. Select service hotels are more resilient than full service hotels, and it is a better place to be at this time in the cycle. In terms of geography, West Coast markets, San Francisco has been outperforming many others, and a number of private equity transactions have happened. M&A activity is robust, and I think it's a good idea, at least according to them, to acquire hotel properties in the private market rather than the public market at this time. So these are their thoughts, and I'm just the messenger. Thank you so much for listening, and I hope this has been helpful. Bye-bye.